Most silver investors focus on one thing: price. They watch it rise. They celebrate gains. But almost nobody prepares for what happens next, the moment you decide to sell, because that's when a different system activates, not the market. The system behind the market. And most people misunderstand it completely. Right now, thousands of investors are sitting on massive gains. Silver that was bought at $20. Now, trading above $80. On paper, that looks like a win. But the real question is this: what happens when that paper profit turns into real money? Because this is where most investors make expensive mistakes. Some assume everything is reported automatically, so they overpay. They disclose more than required. Others assume the opposite. Paperwork means no obligation, so they underreport or don't report at all. Both are wrong, and both lose money. The problem is not the market. The problem is confusion, so let's fix that. Before anything else, you need to understand one critical idea. Reporting and taxation are not the same thing. They sound similar, but they operate completely differently. Reporting is about visibility, what the system can already see. Taxation is about obligation, what you are required to declare, and those two don't always overlap. A transaction can generate zero reporting, no forms, no alerts, no signals, and still be fully taxable. If you don't understand this distinction, you're guessing, and guessing in this space is expensive. Now let's break this down properly. The entire system revolves around transactions, not ownership. Simply holding silver does nothing. You can own 10 ounces or 10,000 ounces. There is no automatic reporting, no registry, no tracking system monitoring your stack, because the system doesn't care about what you hold. It cares about what you do with it. The moment silver moves, that's when everything changes. When you sell, when you trade, when you convert it into cash, that's when the system activates. But even then, not every transaction is visible. And this is where most people get it wrong. They assume every sale triggers reporting. It doesn't. Reporting depends on conditions, specific products, specific quantities, specific payment methods. And most retail transactions fall below those thresholds. Think about it. Someone sells a small stack of silver bars or coins. Even if the value is thousands of dollars, there is often no automatic reporting triggered, no form, no notification. The transaction happens quietly, but here's the part that matters. The tax obligation does not disappear. It's never dependent on the form. It depends on the gain. If you bought silver low and sold high, that difference is taxable, whether anyone reported it or not. That's the separation. Now let's go deeper. Not all silver products are treated the same. Some are tied to institutional markets. Large-scale bullion used in commodity exchanges. Others are retail-focused. Coins, small bars, the kind most investors actually own. And these two categories behave very differently inside the reporting system. Retail-level products often operate outside automatic reporting triggers, which creates a gap between visibility and reality. And that gap is where confusion grows, because people start thinking no form equals no responsibility. That assumption is dangerous. Now let's talk about something most people ignore: